Roku getting a downgrade to sell from Seaport Research Partners, citing caution on its growth prospects and a valuation that's tough to justify. It's coming amid a competitive streaming landscape with Disney Plus and Netflix gobbling up a large chunk of the ad supply. For more on the state of Roku, we bring in David Joyce, Seaport Research Partners Senior Media Analyst. David, it's great to see you. So, no fan of Roku. You're telling your clients this one is officially a sell. How come, David? What's the argument?
No, thanks for having me. So Roku shares actually have done quite well in the fall. We just launched coverage back in early October, and it was roughly 70. It dipped to 56 before earnings and then went on a tear last week, even touched 110. So that's just in the course of a couple months. It was trading last week at 3.5 times revenue. Even today, it's at 3.1 times revenue, and they're still burning cash through most of 2025. They do have plenty of cash on hand to handle that, so we're not concerned about their liquidity. I think it is still quite a viable business model. It still has a good position in the marketplace, but where we're concerned is that their ad growth right now seems to be lagging that of the digital video industry. We have them growing maybe 9% this quarter, and another 9% next year. In part, the upfront markets were a bit soft. They also rely a lot on media and entertainment advertising, which has been delayed because of the writers and actors strike earlier this year. The rest of the digital video ad market should be growing in the 12 or 13% range. So on the margin, it seems like their share is slipping. We think that that's going to these new advertising tiers that Netflix has come out with and that Disney Plus has come out with. And also looking ahead, we still have to do more work on it, but Amazon Prime Video is getting more into new video advertising is the expectation, given that they've been investing in content. So that's just one of the areas where I think that the valuation, the enthusiasm on what Roku does is probably played itself out for now. Just a little concerned about what the competitive landscape might be doing on the advertising side. Additionally, we have some concerns about where the device side of the market is going. It's not an area where they're trying to grow profitability, but it is an area where they have really driven a lot of their active users. And the great thing that Roku did for the overall streaming industry was train consumers to start streaming. They got people off of their very clunky, older definition of smart TVs or connected TVs using the Roku devices, and now Roku has its own TV as well. But as people cycle out their TVs and get new ones, you're more increasingly you're having more apps where the consumer can go straight to the content provider, the Disney Plus, the Netflix, and you not necessarily need the Roku device now. Right. So it is an installed base of 75 million that provides a lot of value, provides some ad impressions, but we think that the growth trajectory might be slowing from here.
I mean, and what you describe isn't just a slowing growth trajectory, David. It's almost an existential question about what the purpose of this company is at this point, right? If I can buy a TV from an existing device provider that can do it, that already I can get to all the apps, what do I need Roku for? What do I need a Roku TV for, right?
Well, it is a company that has reinvented itself in terms of adding some new revenue streams. It's doing some more with e-commerce partners. They have on the Roku channel, they've got some of their own content now that they've been investing in. Like it's going to perhaps attract people to watch This Old House and Martha Stewart and other pieces of content that they've invested in that'll have their own ad impressions. So there are aspects to the business model that they've been adjusting, so they have some more of this active user base. And as they roll out more Roku TVs, earlier this year they had 43% share of the new TVs. There's both Roku branded TVs as well that they're producing, as well as those made by others. That is adding to the active user base while they're losing some of the older user base who are cycling out into new TVs. So I'm not calling it an existential issue. I think that they are reinventing themselves, but it's still reinventing within a few buckets of revenue streams that do seem to have some increasing competition on the horizon.
And Dave, I want to get you out of here on this. Sometimes Roku, you'll hear this kind of hot talk, speculation that maybe it could be an M&A target. You think that's a possibility, David?
It's always a possibility. One of my other concerns about Roku is that their adjusted EBITDA metric, backs out a lot of stock compensation that might not be part of the metric of a potential buyer. So buying Roku at this level could be dilutive for many companies. It might not be economic for a lot of potential acquirers unless they can really justify what this can do product-wise to the strategy of some other product set. So there could be a logic to a certain deal, and that would be one of the risks to our sell recommendation, as would be their ability to execute on advertising better than peers. But for now, we do think that they're on the advertising side, you do have some incremental competition from the very big platform companies coming in here.
David, thanks so much. Really appreciate your time today.
Thanks for having me.